jumping right into, let's say, a paradox of sorts, or basically understanding more about the, if not the venture business, the capital business, right? Because increasingly, as we hear on Twitter, on social media platforms, capital is increasingly becoming a commodity, especially with the availability of it, right? And thus that calls for, if not a transition, an evolution of the venture capital business as a whole, right? So would love to understand from you how you look at that proposition, and if you can perhaps give us an insider view of how this model is changing, and what are some of the steps being taken from the venture side of things to ensure that their capital becomes more lucrative, more valuable, and actually adds value to entrepreneurs.
It's a fascinating question. I don't know if you knew this, but our tagline for, I think, the first 5 years was reimagining venture capital for India. So, we obviously didn't think it was serving the needs of the entrepreneurs back then in the first half of the decade. We thought most funds were oversized for what the entrepreneurs needed. So I think the way to articulate the problem, and even when we started, the gap we were looking for is what angels couldn't fulfill and what the VC funds found too early to play. So in some sense, though we called ourselves VCs all through, we modeled ourselves a little on the West Coast model of what's called a super angel fund, which is basically very prolific check writing, 50 to 100K. And it would be no different if actually a Google or a PayPal or a Tesla or a Facebook super angel would write checks over a 4-year period. That's how Fund 1 was run. What we were trying to do, though, cleverly, was to move down an institutionalized path. So we had reserves. We wanted to play into our winners. And essentially, we know that if you don't bring that institutional layer, the value that you can build for the founder only lasts up to the next round. So that's actually the key. The punchline, in some senses, capital is commoditized for a good founder / company for one round at a time. One round at a time. So you can't generalize that across the life of the company. Right. So Tiger's Capital or SoftBank's Capital or Sequoia's Capital or Nexus's Capital or Blume's Capital, they're all different value at different points in time, right? What each financier should determine is whether they're happy being in the stage where they are or they want to scale up or down, right? Someone like Sequoia has decided they want to be all across the spectrum, right? An angel investor will say, I'm happy being in an angel stage. Blume has decided that we'll slowly evolve and grow, right? But we'll never write like a Series A check. But what we'll do is we'll support our companies through another round or two, right? And so what you're doing, therefore, is signaling that I want to add value is a combination of everything. If you just simply add value without putting any capital and skin in the game, people will say, hey, this all value add is fluff. Where's the capital? Once the company reaches a $20, $30 million valuation. So you're just riding on your past laurels of picking this early. You're not actually putting more capital. So we have tried to evolve. There are many players suddenly in the ecosystem, as you can see. When the first half of the decade, there were 5-6 of us. It was waiting to happen, homegrown, trying to solve for this. Institutionalized small ticket capital. That's the problem we were trying to solve. Today, you're partly right when you say capital is commoditized, because I think that end of the funnel has exploded, meaning there are, obviously that from 5 angel groups, now there are 15, 20 angel groups. From no platforms, there are half a dozen platforms where you can build syndicates, right? Whether that's venture capitalists or Let's Venture or AngelList or whoever it may be. And there are no family office funds, there are probably 10 or 15 of them. From no specialized funds, there are 10 or 15 of them. So it feels like it's commoditized, but when you look at the flow of entrepreneurs shooting for capital, it's a very, very wide funnel at the top. So there's still, it's commoditized for extremely well-connected or established entrepreneurs, right. Not so much for the others. There's just a distinction. You're right. That doesn't mean all the 2,500 people who pitch us should be funded. A lot of them don't deserve venture financing, so to speak, right? They should raise friends and family financing. So since your question was couched in the broader, or most of your questions in your discovery is couched in the broader sense of what should young entrepreneurs do. Young entrepreneurs should therefore also be smart about gauging what capital suits them for the kind of startup and the kind of business they're building. And in a very, very, to dumb it down, the minute you touch institutional capital like ours, it doesn't matter whether I'm playing 1 million or 2 million or somebody's playing 10 million. All of us are playing for the same outcome, which is a $500 million to $1 billion minimum outsized end outcome. right? Of course, we can further dream and hope that it becomes 5 or 10 billion. It was unthinkable till 5 years ago that you could actually envisage such outcomes in India, right? Now we're all beginning to dream that that's possible. Once you have 30 unicorns, you can assume that half of them will go to 3, half of them will go to 5, or whatever. A third will go to 5, and a small percentage will go to 10 as well. And so when that happens, though, and you start scaling your fund size, then you basically have to build outcomes which are that large. Therefore, institutional VC is not for everybody, right? A lot of people should stick to friends, family, build to a certain scale, and then commit to like this crazy rat race of building at scale at an incredible speed, which is not, I almost say that it's a parallel world. It's very unnatural to be building in that fashion, right? Incredible demands on the entrepreneur, on the leadership team, on the way an organization scales, the number of times it's broken deliberately, accidentally, and then refixed. This you will not find in any other corporate job. And so when you're signing up for that is where all the pieces come together, which is then the founder is like struggling. They might be the best founder of that generation. They still have issues, right? And so then the capital can step up and say, I'll actually ease some of those pains. You don't want to run the company. They run the company. But you want to be able to enable them to become superheroes, them or their L1s or their L2s. So as we have grown, we've realized that it's not about one person. It's not a superhero. It's a team of superheroes. And your ability to enable those superheroes to perform better is basically the function of the firm. The capital, once it's crossed over from your bank account to theirs, you're done. What more can you do, right? It's very nervous to go ahead and put, just because I have capital, even if I had a bigger fund, it's just not like it's a blank check that I go and give them another round of capital. That has to be contingent on performance. So what gets measured in every 1.5, 2 year cycle is, do they deserve that next check? Market votes for it. I vote for it. It's not different. If you're truly objective, it's the same decision. So the odds of whether the company takes off or not and proves that it's worth another round and another round and another round. Because think about it, every time you raise a round, expectation of the incoming guy is, oh, it'll go to 10x from here. That's Series A. Series B, 5x from here. Series C, 3x, 4x from here. So there's no end to the ambition that somebody collectively puts on the thing. And each one of those is non-trivial. I mean, if it reaches that steady state, you don't need value add. I'll be blunt. Like that's when you go public, or that's when you take large private equity checks. Nobody values it. They just come for the board meeting because it's protocol, right? You can make one connection or the other. You can, but the value add keeps diminishing as you scale and gets more focused. And so each firm tries to figure out where you can do that best. And there's no way any firm is better than like the 6 on 10, 7 on 10 on the concept of value add. And most people who say they value add are probably not better than 3 or 10 or 400, right? Because the founder has infinite problems. You go and ask them every day. It's like being a permanent shrink. There's always something to solve. There's always fast. You can always grow faster. You can always grow bigger. You can always be better. It's so difficult to solve that to perfection. So what we've done is we've seen where problems surface in multitudes and basically build, specialists, or try to bring specialists, align with specialists who can solve for that problem. It could be something as simple as talent acquisition. It could be something as simple as getting Danda through BizDev. It's of course capital. So we have like almost an internal banking team, and that's how you evolve. And I think that's the nature of a good VC, like reacting to what your portfolio wants at scale over and above the capital. As I said, the capital value, once it's in the bank, the founder is going to say, so what? Unless you can give me the next round, your value is done with that check, right? After the wiring.